Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've seen the latest coming out from the Reserve Bank showing they've kept the official cash rate at 5.5%. That was expected. Where they think it's going to the future, perhaps not as expected, but obviously they're still worried about those pressures showing through in the economy, particularly the non-tradables, the domestically based inflation, just remaining far too intense, far too sticky for them. It's declined only in a sense to 5.8%. Headline inflation, of course, down to 4.0. So a lot of the inflationary pressure that's come off so far coming from internationally based trends, not actually here at home. I mean, are they right to be worried, and for how long might that stick around?
I think it's certainly right to be focusing on that non-tradable inflation at the moment, because that is the stuff that the Reserve Bank can do anything about in terms of lifting interest rates and therefore having an impact on demand in New Zealand, whereas all the rest of it, the international price pressures, little control or no control in many cases that the Reserve Bank has over the trends that are coming through there. Look, they highlighted in their latest statement some things that they've talked about before in terms of local authority rates rises, in terms of higher energy costs, in terms of higher insurance costs, all those being faced by households coming through in coming months. So still yet to really be felt in terms of the full impact of many of those. And so they're worried that that feeds through into an environment where price pressures and cost pressures are already sticky, and this sort of maintains that in specific areas. What was also interesting for me, though, is that they also talked about the labour market. And what we have seen with the labour market over the last year is that the unemployment rate has been gradually trending up, now sitting at 4.3% and has, lifted in the most recent quarter to that level. But we haven't seen a great deal of an easing in labour cost pressures or labour cost growth yet. In the private sector, it's come down by about 0.7 percentage points over the last 6 to 9 months. So there are signs that it is starting to ease. But from the Reserve Bank's point of view, it's still uncomfortably high, still well above historical norms. And they're concerned if you go forward another 12 months, if people are still being sort of paid these catch-up pay increases because the cost of living has been rising and they're feeling like they need more money from their employer to sort of get by, the bank is worried that if the economy at the same time is going sideways, that's just ratcheting more costs through into the economy, and therefore we could still be looking at a non-tradable domestic inflation problem this time next year. So look, those concerns, there's validity to them, but what was interesting for me coming out of all of that was the Reserve Bank then in their statement started to talk about the possibility of a rate rise, which of course is well at odds with what markets have been expecting. We've seen financial markets through the last 6 to 9 months really honing on when rates are going to be cut rather than thinking about a rate rise. So quite a surprise there, wasn't it?
Oh, absolutely. We were totally expecting an on-hold call for the official cash rate this time. We weren't sort of expecting them to talk much about when they might cut, but the sort of general thinking still from everyone was, even if they don't say it, that it's either sort of a hold or a cut at some point. It was just a question of when. The Reserve Bank sort of put the kibosh on that and said, actually, no, our decision at the moment is whether we hold or whether we actually put it up. Not only did they talk about raising, they said, look, we specifically mused amongst ourselves as a monetary policy committee of if we need to raise at the moment, but they also raised their forecast track that they published for the official cash rate. Now, if they just moved the forecast track a bit, we probably could have moved by that. We could have thought, look, there's just a bit of fine tuning going on in the forecast, but it was the fact they talked about it as well that sort of they're very clearly now saying, look, we're still actively considering having to make more moves. Seems to put them a little bit at odds with their own talk where they've said, look, actually, we're comfortable that current levels of interest rates where they are constraining the economy and bringing things back. But it seems like not only are they worried that domestically based inflation might stick around too long, but that it actually might require a little bit more. I mean, with that sort of talk of having to do a bit more, they've also pushed their forecasts out into the second half of 2025. So, the expectation now, it might take until the second half, as we get through July, for the Reserve Bank to even cut for the first time. That means if you're a household, you're a business, you've been talking about, survive through to 2025. Now you're waiting not only 6 months or so, you're actually having to wait perhaps 12. That's a much longer period of time that pressure could come forward. Now, part of it seems understandable a little bit, given that, again, from the Reserve Bank point of view, they're seeing too much of that pressure still sticking around. They've got a job to do. They want to bring interest rates to bear and really bring down that inflationary pressure. And so far, we haven't seen it. We've seen the economy weaken, but not that sort of pullback yet in the domestically based inflation we've just been talking about. So they might have to prolong it. What does that mean for our view, though? I mean, realistically, if the Reserve Bank's pushing it out that far, that's got to make us reconsider what we're up to when it comes to our forecasts and our expectations of the economy.
Yeah, I mean, look, we were looking at the non-tradable inflation numbers and already a little bit uncomfortable with a November cut. And so our view now has pushed out to the first cut occurring in February. So that's a reflection of those non-tradable pressures, but also of the Reserve Bank and their own attitude where they've pushed out the timing, as you say, of when rates start to get cut, and the fact that, well, they're thinking about raising rather than cutting at the moment. So it's hard to envisage a world where in 6 months' time they're actually at a point where they've got enough information or enough confidence that they could start to cut the official cash rate and ease monetary policy at that point in time. And it is interesting when you look at other forecasters over the last few weeks, they have been gradually pushing their timing out as well. And many forecasters now out into that sort of early 2025 range rather than the second half of this year as it was previously. The worrying thing for me, though, is, look, over the last 2 or 3 months, you and I have been talking to clients and businesses across the country, and everybody is talking about how things have got more difficult. Households are feeling the pinch. Business profitability is being squeezed, and they're seeing revenue lines and sales going down. Those are not the sort of messages that you hear when the economy needs more interest rate rises. Now, I'm not advocating for a cut at the moment, but I think looking forward from here, it's clear that activity is under quite a lot of pressure. And, the Reserve Bank, all things being considered, they should be able to set interest rates looking forward. And so maybe by the end of this year, sure, non-tradable inflation might still be at 4% and headline inflation, still sitting at around about 3%. But the Reserve Bank needs to be looking 12 or even 18 months down the track to see how those variables are going to be coming out and go, okay, they'll be back to target by then. So we think we can gradually start to ease. And by easing, I'm not saying put your foot on the accelerator. All it is taking your foot off the brake just a little gradually to sort of get that economy going, ease some of that pain and have things back on a more even keel. The risk is with the Reserve Bank's own forecasts, if they're not cutting till the September 2025 quarter, headline inflation will be just about at 2 before they start. And there's a real risk, I think, that then they start to undershoot their inflation target on the other side. I mean, look, we've seen it over the last 3 years. They were horribly slow to raise rates, didn't raise them fast enough, and were very late to the game. Could well be the same story on the other side.
Yeah, so, and that is the worry, right? The Reserve Bank's got to be looking into the future. It's got to be forward focused. It's got to be thinking about what's coming around the corner. Because even if they did raise, earlier this week, it would have taken a full 12 months or so for that fully to come through. And it's, it's one of those things where for the economy and how the Reserve Bank's setting it, you do have to start worrying that they are looking too much in that rearview mirror. As we came through the start of the pandemic, completely appropriate to drop interest rates, try and stimulate some activity. But when it was clear that the economy was going fine, it didn't need a whole lot more stimulus, we kept our foot on the accelerator. We ourselves at Infometrics said, that we were worried that we might be overdoing it. When we started to raise, we probably didn't do it quickly enough. We've now got in that position where we had such high inflation that we're having to sort of hit the economy so hard on the other side. And so I think you're right. I think the risk is now that we do move into that overcooking mode. But for the Reserve Bank, I guess what they've sort of said pretty consistently so far is that they've got a job to do. They're worried that they haven't met their mandate for such a long time, and they're really sort of putting their whole being into it to try and get things under control. I do think the risks sort of increase from here that they overcorrect too much on the other side. We'll assess how that goes, how the Reserve Bank assesses all the other data, and how we think things are going on one of our future editions of Econ Talks.